Well, inflation is too high. Let's start with that. Now, we think we've seen possibly this week, the first glimmer that with the figures that were released this week, that it's not only beginning to come down, but it was a little bit below where we thought it would be, and that's obviously very good news, but there's a long way to go.
This article comes from The Guardian, guys. The governor of the Bank of England, the B.O.E, has said there are signs inflation was now beginning to come down from its 41-year high, shortly after raising UK interest rates again to their highest level in 14 years, which, like I've said, could have been avoided had they not forcefully implemented such harsh policies that hurt the economy rather than help. But that's my opinion. Andrew Bailey said this week's inflation data, which showed prices rose at a slower annual rate of 10.7% last month, was a glimmer that inflation was coming down. This is fireworks, guys. Inflation may be coming down, prices are not. Plus, like I've said before, inflation wasn't supposed to be where it's at if the government around the world would not have intervened like they always do, making it worse for civilians and entrepreneurs to let them do what they do. Let's continue. The bank expects inflation to start falling more rapidly from late next spring, 2023, and lower than the B.O.E expected, Bailey said, but insisted that it had to raise rates Tuesday to offset pressures from a tight labor market. This is his exact words to broadcasters, quote, "We expect inflation to start falling more rapidly, probably from a tight labor market, but there is a risk that it won't happen in that way, particularly because the labor market and the labor supply in the country is so tight. And that's why really we had to raise interest rates today, because we see that risks as really quite pronounced," end of quote. Bailey was speaking after the B.O.E voted to raise UK interest rates for the 9th time in a row this year, 2022, to 3.5% from 3%. But the decision was not unanimous, with 2 policymakers voting for no change and 1 arguing for a larger 75% basis point hike to 3.75%. Economists predicted that the UK rates could peak at 7.5% in 2023. But let's get more information. Editor, roll clip, fair use.
Europe got more big rate hikes on Thursday, to absolutely no one's surprise. The Bank of England lifted its benchmark rate by half a percentage point to 3.5%, marking a 9th straight rise. Despite signs that a recession is looming, it also warned of more hikes to come. The bank says inflationary pressures remain high and the labour market is still tight. Governor Andrew Bailey says that justifies further forceful measures. Investors now expect rates to peak at just under 4.5%, slightly down on earlier bets. There was a similar story over at the European Central Bank. It too raised rates by half a percentage point, taking the benchmark to 2%. That was its 4th straight increase. And Bank President Christine Lagarde kept further rises very much in play, warning it would take years to get inflation back down to target levels.
We decided to raise interest rates today and expect to raise them significantly further because inflation remains far too high and is projected to stay above our target for too long.
Thursday's increase was, however, at least a little smaller than the 3/4 point hikes of previous months. Global stocks slid following the increases, which came after a similar move by the US Federal Reserve a day earlier. In Europe, the regional Stoxx 600 index was down close to 3% by mid-afternoon.
And and we expect that to happen, by the way. We expect inflation to start falling more rapidly, probably from the late spring onwards. But there is a risk that it won't happen in that way, particularly because the labour market and the labour supply in this country is so tight. And that's why really we had to raise interest rates today, because we see that risk as really quite pronounced. I think there are a combination of drivers. So more of the drivers have been external. Obviously the war in Ukraine is having an effect, a very big effect on energy prices and on food prices as well. We've seen disruptions in supply chains around the world. Now, we're seeing some of that starting to ease off, I would say. I think the supply chain issues are starting to ease off. So it's a combination of shocks going on. There's a domestic shock in terms of the labour force, but there are some very big external shocks that have been hitting the economy and causing inflation to be higher. Well, I'm not going to speculate on where rates will end up because that really does depend on how things unfold. What I would say is that I think, in terms of, you look at the history of the Bank of England's, history of the Monetary Policy Committee, a 0.5% rise is still a very big one. I mean, we only did the first 0.5% rise earlier this year, so I would put it into that context. And we will have to judge, as we will do, in a few weeks' time when we have the next meeting, what's appropriate next time. So I'm not going to speculate on where they may end up or what we might do next time at this stage, because there will be a lot of information that we'll get before we get to that point.
Well, I know you're also not going to comment on what the government are going to do, because no one knows at this point. But if we do end up in a situation where the government did deliver on fiscal tightening, does that take the pressure off the Bank of England to tighten rates?
Well, we would put that into our assessment process and into our next forecast, and it will be part of the conclusions, because we do condition our view on what we call announced government policy. We had to sort of think about slightly reconfigure that this time for the energy policy, but I expect we will get a set of announcements when the Chancellor makes a statement, and we will take those into consideration.
Now, over the last couple of weeks, we've had the likes of Bank of Canada, RBA, today Norges step down a little bit with their pace of hiking, namely about concerns on what higher interest rates do to mortgage rates and the impact that that's going to have on the real economy. Is this less of a concern for the Bank of England?
Well, the mortgage rate and the mortgage housing market, of course, features in our assessment of the economy in the same way as I'm sure it does for other central banks. So we're all keen followers of our housing markets and our mortgage rates. I think the other thing I would say is that, of course, what ultimately we target is inflation, price stability, and that will, of course, have a big impact on what future mortgage rates will be. So that's important. I would also say that I don't expect that the rate increase that we've made today will feed through into, it will feed through into those who've got variable rate mortgages. I would not expect it to do the same into new fixed rate mortgage deals, and those are the largest part of the new market in this country, for two reasons. One, because the market had actually priced in what we were going to do today. They just concluded that that's what we were going to do. But secondly, this point I've made that we think the curve went too high, and we've made that point explicitly, and we'll leave the market to reflect on that point, and that will, of course, influence future mortgage rates.
And I know this was an MPC meeting, but I just want to ask you one question about financial stability risks.
Yes.
Would you deem them to be less today than they were, say, before all of this kicked off, before the mini budget?
Well, I mean, we had to deal with a particular, quite marked financial stability risk in this country, set off by the very pronounced movement, particularly in long gilt rates in this country. I think we have dealt with that now, so that particular issue. But I think it does point to a whole set of whole part of the landscape, particularly the non-bank finance world, which we've got to globally have much more effective scrutiny of, because we've had a number of what I might call incidents in that world, and this certainly dominates discussion in the Global Financial Stability Board, for instance. So I would say, in terms of our sort of surveillance of the landscape, I think the alert level is pretty high, frankly, at the moment, because we have had a few quite striking incidents.
Hey guys, it's Jose, your regular Joe Blow again, keeping an eye out and my ears open to crazy times that give me the energy to do my best to bring you the best. Thank you for the support always, but always do your own research for better clarification to thrive for you and your families. Why can't we prepare and excel with all this chaos the banks and the government have caused? This is our time because we are aware and prepared. So when opportunity presents, we execute. No mercy. There is no luck. We get info, then plan accordingly, and opportunity meets preparedness. Wow, that's our type of luck. And we are in the path. Great things truly come to those prepared. Let's get it. God bless all of you and a happy new year, happy holidays to all. Stay free.
It ain't hard to tell. I excel, then prevail.